Merry Christmas, everyone! Now, I don't want to take up too much of your time today. I'm sure you're full and just kind of ready to go to sleep or something. Boxing Day belly. But this week, I want to talk about the things that I've learned from the crazy year of investing in 2021. My name's Paul, I'm brand new to investing, and I've started a dividend reinvestment portfolio on Trading212. This channel was started to document my investment journey all the way from zero right up until probably when I die. And I hope that in 2030, that's a bit soon, isn't it? Oh God, am I going to die in 2030 now? I hope that some kid who's living on Mars in the future comes across these videos and decides whether this style of investing is for them or not. It's personally the best style for me right now as a beginner who doesn't really know how to invest. And I hope that eventually this channel becomes a chronological documentation of whether it worked or not. If it didn't work, this kid knows to just sack it off. But if it does work, then they might be able to consider it as part of their investment strategy. I guess they'll just have to figure out which DAOs pay the best dividend or something. And I spend pretty much my entire week now, because I've got no job, continually trying to learn about the stock market and about my own mistakes. And of course, the mistakes of others. And in 2021, this is what I've learned. In 1, the efficient market hypothesis is still a bag of bollocks. The efficient market hypothesis states that every stock is priced perfectly based on all information out there that is known. Therefore, it's impossible to find stocks that are either over or undervalued. But 2021 took another massive turd on that thesis. If the efficient market hypothesis were true, we wouldn't have places like Wall Street Bets manipulating stocks like AMC and GME based off absolutely no information at all. I like the stock. And stocks like Bristol Myers Squibb, ASOS, and even Tesla wouldn't have skyrocketed again based on news that didn't really affect them. Ultimately, it means that beating the market is possible. It's still not entirely clearly though if that can be done long term. Number 2! Fear and greed are very much still in play. Jerome Powell just has to mouth the word inflation and the stock market goes in any which direction that Nancy Pelosi tells it to. The sheer amount of volatility that we've seen in 2021 and the year before just tell me that investors are dumber and more emotional than ever. Proceed with caution.
Number 3.
It's not a new paradigm. There's been no shift from value to disruptive innovation. In fact, innovation has always been there. People just get really excited about it. Humans go around like investing goldfish. They just forget where they've previously been. But if you look at even very recent history, things can go really bad. I'll admit, I was a little bit worried there in early 2021. Even I was listening to all that crap about investing being different now, when in reality, stocks follow earnings. Over the years, different stocks go through many different hype and despair cycles, but in the long term, they all follow their earnings. It's just sometimes when stocks are in certain sectors, we get really excited about them. But in the end, they overcorrect and revert to the mean. This year has been no different, and if you had invested into the ARK Genomic ETF, you'd still be 137% up. Good work if you got in there at the base of 2020. But if you got into it any time recently, you'd be 42% down. And I just cannot see 2022 being another year where ARK Genomic ETF goes up another 257%. But if it's true and stocks do follow earnings like the S&P 500 has forever, now we're just waiting for that reversion on the big one. Number 4! Stay diversified. Remember, this is learning for me and not for you. Reddit is crammed full of undiversified portfolios. Some users are left staring at just one stock that's down God knows how many percent, like some asshole dog who's just looking at you after he's torn up your living room. No, Lemonade, that's not cute, you're a fucking asshole. I tell you what, I'm just gonna sell you and buy something else. Highly speculative growth stocks are not just for Christmas. I'm just sort of imagining like a dog shelter where you go along and you go, oh mummy, can I have that one for free? And it's like Workhorse. I don't quite know how to convey that joke right now though. In 2022, I plan to be a bit more diversified, possibly out of stocks and maybe into property, but also aiming to diversify my income a little bit. Would help if I had a job though. More on that in the new year. Number 5! The media, including Reddit, FinTwit, YouTube, and fucking TikTok are the worst. With certain stock pickers trying to push stocks on people which absolutely collapse. But even relating the news to your investment strategy is just stupid. Remember recently when supply chains were going to ruin Christmas and no one was going to get their presents? Well, it turns out that was its own whole pump and dump scheme which just blew over. Christmas is fine. We wanted our stuff and they wanted to sell us their stuff. It was in everyone's best interest to get the supply chain moving. First world problems. So the news is going to be turned off, and I'm only going to be listening to people who are going to try and positively affect my investment journey, and I'm going to continue to actively ignore anyone who's trying to grab my attention by using fear. Okay, time for possibly my last portfolio update of 2021. Currently my portfolio sits at 40,123.66, and again, like last week, the market was extremely volatile. Every week and hopefully continuing through 2022, I hope to keep up this level of transparency with you to show you exactly what's been going on in my portfolio. And on top of that, I hope to talk to you about my life and the things I'm doing to try and increase my wealth. As of the 24th of December, I am just beating the market. My total deposits into this portfolio over the past 2 years have been 31,641.04, and my current end share price is 40,114.52. And that leaves me with a 26.7% total return, including dividends, including sells and buys and all that. This is versus 24.66%, which I would have if I had just invested in the S&P 500. The way I calculate this is a very crude way of calculating. I'm not entirely sure if it's accurate, to be honest with you. But every time I deposit into my account, I take 5% of that money and I immediately put it in the S&P 500. And I've pretty much been doing this since day one. So the humble brag is that I'm just beating the market. But of course, I'm very wary that this could all change next year. And there's some stocks like AT&T, Discovery right now, Medtronic, and my biggest disappointment, which is actually another broad-based index fund, which is the Vanguard FTSE Emerging Markets ETF, VFEM. Those are the bad boys that are bringing me down, but I do expect them next year, particularly AT&T and Discovery, to have a few catalysts that might bring them back up to speed a little bit. With AT&T though, I'm not holding my breath. But I have made changes. I have been trying to concentrate my portfolio just a little bit. I currently have 25 investments and I've cut that down from about 30 investments. I'm slowly trying to get rid of those less conviction picks that I would have had when I started. And perhaps my biggest and maybe surprising change recently is that I sold Visa. I've done plenty of videos on Visa and why it's an exceptional company, cash producing, giving back to shareholders and blah, blah, blah. Don't get me wrong, I wouldn't short this stock in a million years. But after Amazon decided to block the use of Visa credit cards here in the UK, I decided I'd take a little bit of a deeper look into why they did that. And in my previous videos on Visa, I explain how they are just squeezing the crap out of all of the merchants in the world through raising their fees every year. It generates a stupid amount of cash flow, and between Visa, MasterCard, and a little bit of American Express, they pretty much have a monopoly on the space. But there's a point where you have a monopoly that is creating good, and I would argue that Google search engines are a good monopoly, and a point where your monopoly just becomes a nuisance, which is where you could argue Google will be in the next 10 years. And the thing is that merchants hate that Visa can do whatever it wants. They're beginning to value the service less. When you're simply holding companies at ransom and not providing much value, they do their best to find other ways to get around you. And I've only just realized how much of an annoying nuisance Visa actually is. It goes children, solicitors during house buying, then probably Visa. This is why you've got new style payment platforms like PayPal and Block, who are coming in to try and create an alternative protocol system. And then ultimately, if you stretch it really long term, cryptocurrencies probably are going to be the solution to this. And these cryptocurrencies don't even need to be decentralized. These can be stable coins that are created by central banks, all a fully automated payment system that will go around the world. Here is how payments with cryptocurrencies would work. And here is currently what Visa's business model looks like. You see the difference? Bitcoin, Visa. Ethereum, Visa. Solana, potentially, Visa. Obviously, they aren't exactly the same yet, but with the uncertainty there and the change in my mindset, I could see Visa having a couple of rocky years. I'm just gutted I'm going to miss out on that massive operating margin. And with that money, I sold Visa at £67 profit, which isn't a lot. And I bought £200 worth of VFEM, a little bit of AT&T, a little bit of Lennar, well, quite a lot of Lennar, a bit of Medtronic, which I'm going to go onto in a second, a little bit of Legal & General, and I've started buying Disney again. I've also just this morning deposited £500, which I've already put into the S&P 500 ETF, and the other £475 is going into Medtronic. Medtronic has been doing so well over the course of 2021, but in the recent months it's had a 23% pullback. The largest part of the pullback, which was around 7%, was all down to the US regulator sending a letter to Medtronic to look into their diabetes business. There's been a problem with the loading mechanism on one of their diabetes machines, which is quite a large part of their business. It's led to a recall, and Medtronic are going to be repairing and placing all of the machines. This has led to a reduced forecast, and it doesn't look great for Medtronic's diabetes business. But then I read this quote from JP Morgan: "The hit to the financials isn't great, but worse, it's likely to hit the investor sentiment." To me, that's code for it isn't that bad, but everyone's going to lose their shit. And thank you to Kamal on Instagram. When I posted about my sale of Visa, he suggested that I look a bit deeper into the problems with Medtronic. And Debbie Wang has written a very recent note on the struggles with Medtronic's diabetes issue, stating that the FDA hasn't actually written the form yet, and this would imply that the problem isn't as bad as we first thought. A 7% drop in share price suggests that all the diabetes revenue will be halved, when in reality Medtronic only believe it's going to go down by single digits. Historically, product recalls happen all the time and don't lead to 4 years worth of revenue loss. And most importantly, like some people originally thought, the warning letter has not resulted in a halt in manufacturing. They're still building the things under a new design, no problem. So this has led to Medtronic possibly coming back into fair value. It's now 12% under the Morningstar fair value of $129, which puts it at a 4-star rating. And on FastGraphs, based on analyst estimates, it's 13% a year undervalued, based on its terminal value continuing to be a 20 PE going into 2024. And I've been waiting now for 2 years to start adding to Medtronic. It's got a lovely wide moat in coronary, it's moved into 45 hospitals in China recently, and of course still owns half of the diabetes pump market. So to be clear, I'm not telling you to buy it, but I'm going to double my position in it. And I'm serious, do not copy that, go have a look, go see if you like what Medtronic does, learn about the products and things. Don't just listen to me or Morningstar or Kamal27 on Instagram. And finally, a quick look into dividends. Not that I really care. In December 2021, my dividend income was £60.95. That's a total of £984.53. Thank you very much for watching, everyone. And if you enjoyed this video, Merry Christmas and Happy New Year. That's weird.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.